There are three lies, claimed Mark Twain: lies, damn lies, and statistics. He used the quip to describe the persuasive power of numbers. One of the biggest lies I've come across in my almost 50 years in optometry is virtually every optometrist's description of their cost of goods. My cost of goods is 21%. What's yours? Is a common statement and question. The very question is deceptive at best, and here's why. First off, your cost of goods isn't your cost of goods. As most of you manage your finances using cash basis accounting, what you think is your cost of goods is actually your cost of purchases. In simple terms, with cash basis accounting, when you load up on product, your so-called cost of goods goes up. If you don't buy anything this month, your so-called cost of goods goes down. There's no connection with revenue, and therefore the number that you describe as cost of goods isn't. You're buying inventory, and the frame that you sell this month could actually have hit your books as a purchase months, if not years ago. Start thinking of your cost of goods in the right way. When you and your team make a purchase, you're adding to your inventory, which is an asset or an investment. You only create cost of goods when you sell the product. Why is this important? Because your job as a business owner is to properly manage and deploy assets, whether financial, product, or people. This means ensuring that you're buying smart and pricing smart while managing your inventory investment. Inventory management impacts your business in a host of ways. As one example, many of you are very proud that we have over 1,000 frames in stock. While that may seem like a good marketing approach, it's most likely not. First, patients are confused by too much product. After a few minutes, all the product looks the same. The lack of white space makes the selection process more stressful because the patient is visually overwhelmed, just like you are when you go to a trade show. Better to reduce inventory and open up your displays so that the patient can actually see the product. Less is more. Another benefit of a reduction in displayed product is that inventory is an asset. And all assets have a cost of maintenance, a carrying cost. Let's say that you have 1,000 frames in stock and each one costs $50, resulting in an inventory investment of $50,000. At a conservative opportunity cost of money, say 10%, your inventory costs you $5,000 annually in carrying costs. This includes the lost income on the asset, the cost of managing the inventory, shrinkage, wear and tear, etc. Asset carrying costs are a hidden drain on profit. So how much inventory should you have? A good rule of thumb is that you want your inventory to turn over 3 to 4 times annually. Thus, if you expect to perform 3,000 exams this year and your eyewear capture rate is 60%, you expect to sell 1,800 pair of eyewear. If you want a proper return rate, you need to reduce your inventory to about 500 frames, keeping in mind that there's likely a minimum of which you shouldn't go below. Using this example, you'd reduce your inventory from 1,000 units to 500. While that sounds drastic, a well-curated collection can actually generate more revenue than just a bunch of inventory. Economically, you'd have an additional $25,000 in capital to deploy elsewhere to make even more money, and you'd reduce your carrying cost by $2,500 per year. That's real money. Now, there's another important issue to understand about cost of goods. Comparing your cost of goods to someone else's is an exercise in misinformation. Why? Because unlike 30 years ago, when an optometry practice was an optometry practice was an optometry practice, in today's world, each and every one of you may have a different mix of business. A practice with 45% medical fees will automatically have a lower cost of goods than one that just produces 40% of revenue from professional fees. A practice that generates 10% of revenue from developmental vision services will have a lower cost of goods than those who don't supply the service. A practice which specializes in high-end product with a relatively low level of medical services will have a higher cost of goods. Unless you look at true cost of goods, not cost of purchases, in relationship to actual eyewear revenue, comparing to yourself is far more effective than comparing to others. Comparing cost of goods to total revenue is misleading at best, and any comparative reference to cost of goods between two different practices is an apple to oranges comparison. Inventory, like accounts receivable or any other asset, requires diligent management to ensure that you're maximizing your return on investment. This is another important reason that accrual accounting should replace your current cash accounting system. Cash accounting system is at best garbage in, garbage out.